When you've got a small GP share of a $30 million property, I don't claim, and I'm not super active on that particular deal. But anyway, yeah, I've got a little bit of experience, that's for sure.
Mr. Tom Kirkpatrick. So, Tom is the founder of Town Square Capital, a private investment firm focused on professionals diversifying their retirement savings, passive multifamily real estate. Tom has over 35 years of experience in corporate world as a geologist and later as a project manager overseeing larger scale environmental remediation projects. So Tom brings a pretty unique blend of analytical rigor and operational discipline to every investment, which is pretty cool. He began back in 2016 with a small apartment, getting more hands-on experience, and then added investing through self-directed retirement accounts. And right now is focused on his improvement by partnering with top operators in U.S. markets using fund of funds, which is our bread and butter too. And Tom helps people build financial stability through recession-resistant real estate without the stress of being a landlord. Tom is also a U.S. Marine Corps veteran. So thank you for your service, Tom. He lives in Tennessee with his wife, Stacy, and I've spoke with him quite a few times. Tom is a great person. And he bought his first property in 2016. So far, I believe you've acquired about 10 million in assets. Is that right, Tom?
Yeah, I'm general partner on about 35 million, but my general partnership role on some of those is small. So I don't like to stay to
Mm-hmm.
have 35 million assets under management because it just seems a little presumptuous. But yeah, 10 million, that's somewhere in that ballpark. Yeah.
Awesome. Okay. Hey, you're being modest. So we
Yeah,
know
well,
you have.
when you've got a small GP share of a $30 million property, I don't claim, and I'm not super active on that particular deal. But anyway, yeah, I've got a little bit of experience, that's for sure.
Hey, most people put it on their LinkedIn that they are an owner in all those properties. So at least you're being honest about it,
Well,
right?
I listened into a podcast the other day, and it was this lady who vets operators for LP investors. And she was saying the
Hmm.
number one place where operators misrepresent themselves is in their assets under management. So it made me sensitive to that issue. So anyway.
I hear you. I think many people are glad to hear that you're forthcoming about what you actually own. And so far, you've gone full cycle on a 13 unit, your GP on 34 and 193 units right now, right?
Correct. Yes, sir.
Awesome. And how much have you personally raised for your deal so far using fund of funds?
I have raised about 600 grand to date. So this is all new to me. Capital raising 2025 for me is a year of capital raising. I was really more of an acquisition guy prior to this year. Yeah, I'm new to the game.
Yeah. And that's why I really interviewing someone like you. When I first reached out to Tom, you have these people that have raised $100 million dollars on the show. But for a lot of people who maybe they've raised $10 million dollars or nothing, you have a lot of experience under your belt, capital raising or not. And someone who has all that experience, but is just now jumping, which we run into a lot, is just now really taking capital raising serious, whether it's 500,000, a million, I think is a very unique perspective for a lot of people that when we're interviewing people who have raised $50 million, dollars, maybe people can't put themselves in their shoes because it's like we
Yeah.
started this 10 years ago. It's
Yeah.
not the same playing field it was in 2010 to raise money. So I really like the perspective that I think you'll bring. So I appreciate you joining us. Yeah. So can you briefly go over your business model as a whole, both what you're doing now on capital raising and just your multifamily commercial portfolio in general? Like what's your general business model right now?
For me, as I said, I was an acquisitions guy, really focused on, spent several years underwriting deals, really 22 and 23, wrote hundreds of deals, evaluated, and it was just so tough to get deals done. So my approach is modified a little bit. My business model is it's two-prong. I like to partner locally, act as boots on the ground for smaller properties in East Tennessee, maybe 20 to 45 units. And then separately through fund of funds, raising for excellent operators in excellent markets with excellent deals. And I started in 2016, so I've got enough experience to where I really feel like I'm able to provide good due diligence for my investors through the fund of funds model.
Yeah. And I'm curious, going back to your start, what kind of motivated you to pursue a career in multifamily commercial real estate to begin? What was
I
the
mean, I
driving
guess we
factor
all
there?
we all always hear that real estate has created more millionaires than any other vehicle. At least that was my belief. And then for me, it goes back further. When I was in grade school, my dad he was a president of a decent company, New York City. He was in a high rise. I grew up in Connecticut, and his company merged, and he got forced out of corporate merger. So here's a guy who was MIT grad, president of a company, and kind of got forced out in his early 50s and never really recovered. So that's something that stayed with me. It didn't keep me from following the corporate path, but in the back of my mind, I always knew I couldn't count. You never know when somebody's going to come tap you on the shoulder. You get a stock market crash and you've got everything in your 401k. So that was part of the motivation, just always knowing I wanted to do something different. I got into a retail venture in 2007, which turned into a debacle, really, because right before 2008. So I had a partner. We sold mostly Costco extra stock, overstock, end of season. We had all sorts of Costco gear coming in, selling shorts in October and November. And it was very successful for a minute. And then '08 started. That was 15 years ago. And then just really in the back of my mind, knew I really migrated to real estate and then purchased this 13 unit, which was about a mile from my house. And that kind of started me down that path.
Interesting. Yeah, I think that is pretty on par with a lot of people. Hey, you never know when you're going to get that tap on the shoulder or when the stocks you're invested in, like we say all the time, real estate is probably more predictive, right, than most asset types, stocks, crypto, especially this time of year with everything going on with tariffs and everything. But real estate, even if the market is down, like it has been the last couple of years, it's still, and all these people on this call are pretty successful. And going back to when you got started, obviously, I don't know what I don't know. You hear it all the time. How did you acquire the necessary skills in order to be successful on your first couple of deals? Did you have a mentor or a coach, or you just trial and error?
For me, I was really, this was 2016. I was looking for a fourplex or something like that. And this 13 unit came available less than a mile from my house. I really didn't know what I was doing. I had read Rich Dad Poor Dad, so I did enough evaluation to figure out this thing isn't going to cash flow negatively. I figured out it's going to cash flow positive. If it cash flows $25 a month, I can afford that property theoretically. So I bought it, started listening to Bigger Pockets, started reading books, going to conferences. I joined on with Tate as a mentor who's on this call back in 2022, I believe. And then groups like this, the Hero Capital Alliance. I joined Raise Masters earlier this year. It's been a steady wherever I can get the information and through mentorships, online opportunities, reading books. I guess really though, the trial by fire with the property certainly gets your attention.
Yeah, and I tell people all the time, I think you can learn a lot through coaching and mentorships. But when it comes to raising money, it's something I think you have to do to figure out how, like, you can watch a million YouTube videos, but it's a little different when you're talking about underwriting, right? Just numbers versus going out and asking people for money at the end of the day. So, can you share some experience from your first capital raise and any challenges you faced and how you overcame them?
Yeah, my first capital raise really was last year for a deal in Columbus, Ohio. It was a 72 unit Class B property that we really loved. And we had a group of general partners that were all working to raise capital. We felt pretty good about it. And it really came down to, for a variety of reasons, we weren't able to close that deal, which kind of leads me to where I am today. But we basically failed at that capital raise and ended up leaving some money on the table, which was pretty painful. But there again, really get your attention. So that's where I really decided to make the full pivot from really focusing on acquisitions. My plan back doing acquisitions was always I'll find somebody who's a capital raiser and partner with them, and then we'll be
Hmm.
fine. That's great. But what if you go a couple of years and then you go your separate ways, and then I still wouldn't have much capital raising capability? So I just finally, after some struggles last year on that property, decided 2025 is the year to focus on raising capital. Like I said, I've gotten involved with Tim and the Hero Alliance. I've gotten involved with Raise Masters and just really trying to go all in on that aspect.
Yeah, and you bring up a really good point, which some people have different viewpoints on, is raising your own capital for your own deals versus raising money for somebody else, but also trying to leverage capital raisers as a GP or for your own projects. You do run into a point where, hey, if you rely on that too much, they're busy on another project, someone raises $1 million for you, and then in 6 months you call them up and they can't do it. You were depending on that to close this deal, or you maybe have many capital raisers and some of them don't come through. Having the muscle built of being able to raise money avoids a lot of that. So I'm curious, like, what about fund of funds really made you want to shift your focus that way and focus more on capital raising? Was it just the negative experience of not finishing out that raise with that first deal?
What it really was, deals were still getting done over the last few years, but the good deals were being done by operators who knew the market. Wasn't usually usually wasn't like an out of state. I'm sure there are cases, but anyway, what I saw was the best operators who were entrenched in markets were still getting, they're on the inside track and they know the market. Maybe they're even finding off market deals. And so it just seemed to make sense, as hard as it is to do deals and to get them to pencil, to then go ahead and partner with those guys who are able to take advantage of their position in the market to get deals done.
And this is a lot of what Tim and what we do at Hero, what we teach is leverage the guys who know what they're doing, who have the
Yeah,
credibility, have the experience. They've got property management in-house, construction in-house, ride their coattails, so to say, in a good way, raise capital for them and build credibility that way. Is that kind of the angle to sum it up, how you were looking at it?
100%. I think you basically can do your due diligence and find not only those operators that you really want to align with, but the markets, the operators, and then the deal. So there's really various levels of due diligence that you want to complete there. And yeah, that's what kind of led me down this path. And I'm loving it so far.
Love to hear it. We love when people come to the fun to fun side. Join the dark side. A lot easier over here. And obviously, credibility is one of the biggest problems people run into when they are raising money. So obviously, doing a fund to funds model does help with that. But a credibility as a person, as a brand, what are some ways that you've tried to establish your own credibility to your investors? What is it? Content? Is it just talking to them a certain amount of times? What are you doing right now to establish as much credibility as possible?
Yeah, I guess first thing is make sure you have a website that looks decent, right? Because people are going to reach out to that. Right now, I've really been working on overhauling my LinkedIn profile. I guess really that's one of the first things that people are going to do. They're going to go check your LinkedIn profile. So I've really put some intentional effort into LinkedIn participation. I participated over the last couple of weeks in a LinkedIn challenge, which I posted, 10 days straight is the goal of the challenge, which stretched me out a little bit. But I think that's all part of it. And just really reaching out with whether it's email, outreach, phone calls. Right now, my investor base is not massive, so I'm able to really reach out almost on an individual basis as needed for those that are interested. And then as far as on the multifamily side, I think that's where I have a lot of credibility as far as just being in multifamily since 2016. That helps me. So I like to certainly focus on that and highlight what I've learned, hopefully a little bit of which I can share here today.
Yeah. And that's a good point, right? For people that have experience in deals, where they're a CPA, right? And they're just helping on that side of the business or acquisitions or underwriting. still leveraging that, even though you didn't raise money for those deals, it's still on your LinkedIn, it's still on your portfolio. So you're a part of those projects, leveraging that and saying, hey, this is the first time I'm raising money or the first $1 million I'm trying to raise, but I still have all of this experience. Like I'm not brand new. And even if you are, you're still leveraging those operators, right? Hey, they have all this track record. So you're doing a little bit of both, it sounds like, right? Leveraging who you're working with and your past experience to mesh those together, which I think is a really good approach. And I think everyone can resonate with this. Like my investor database isn't the biggest. It'll never be the big. You always want it to be bigger, right? Like you're never stopping. For us, it's 24/7, 365. So what are your top couple of methods for finding and attracting passive investors on a consistent basis, or at least ones that are ideal potential investors, like of your avatar?
Yeah, so for me, initially, as I said, I'm new to the game, and everything I learned in what Tim was teaching and on through Raise Masters is if you're really just getting started, and I got into a raise, right? So I'm actually currently raising for a deal. So you have to speed everything up. You can't necessarily just build for the long term. So right now, it's my personal network, right? So luckily I'm old and so I know a lot of people. So that helps a little bit. I've got a lot of people in my
Mhm.
phone. And so that was the toughest is just that transition from friends, coworkers, acquaintances, and then just trying to educate them about what I was doing. So really, I guess my personal right now, and obviously that's got to grow. Pretty much I'm reaching a ceiling already there. So it's my personal network and then referrals from my personal network because that gives you instant trust and credibility with the fact that they know you and trust you. And if they share that referral, that's been very successful. And then right now, I'm really trying to focus on LinkedIn and reach out and connect with my ideal investor.
Yeah, I gotta use that LinkedIn cheat sheet that we gave you in
Yes,
the
sir.
intensive. Um,
Yeah, I've got it.
but that's speaking to the personal network, right? And I hear this sometimes where if someone's not an accredited investor or they don't have 50 grand to give you, or if you're doing a 506c and they have to be accredited, that's a good point where no lead is a wasted lead. Just because they don't have money, but they trust you, they know someone that trusts them, right? They go golfing with their rich golf buddies, right? It's a funny joke I use because you're in Florida, everyone golfs, right? You never know who somebody else knows. And if you build a relationship with them, regardless of their check size, the referrals are going to come in. And referrals are a very underrated way to grow that network because, hey, I invested with this guy. I had a great experience. Here's his number. It can be that simple. Even though it's not always that simple, it can be. And that brings me to my next point. You're raising for a deal right now. What are the strategies? Like, how are you promoting and launching that deal to your current network, which is where everyone should start? How are you getting the word out there?
So in our case, it's 506C. First of all, webinar. I think the number one thing is have a professional webinar and get the word out about that fairly early in the process. Social media posts, email campaigns, using a series of emails. In my case, because I was new to the space, I had to fast track this is what I'm doing. And if a deal comes up, would you possibly be interested? In my case, I already had a deal. So I had to fast track this is what I'm doing. And by the way, I'm actually raising for a deal. So again, that was a little bit of a challenge, but it always gets your attention. You're in a deal, you're raising, so it certainly you've got to take action. But I'd say those are my main: the webinar, social media posts, email campaigns, and then just direct phone calls are the most important thing. You can send all the email campaigns you want, but it's
Mhm.
really important to pick up the phone and make connections because that makes a big difference.
Yeah, it's 2025. I tell people, look at your email. Look at your inbox right now. How many
Yeah,
of those are you giving the time of day? Probably not many. Even
I
people who
know.
know us and Tim, right? We send out a lot of emails. They might not see them all. Where I come in, I call them and I text them, right? But in person is the best. Zoom is pretty close, webinar, and then phone calls. It's a lot easier to connect with 10 people on a phone call than 1,000 people in an email chain. You're still going to send out emails because it's part of the business. But I like that you mentioned, hey, I got to call these people. They have to hear your voice, see your face. The webinar is where the most successful capital raisers we know, that's where they raise the most money, right? Investors want to see the pretty business. They want to see the pretty property. So even though you're new, you're implementing things that more experienced capital raisers focus on as well, which is really cool. And when we're talking about, you said it a couple times, avatar, what's your ideal investor profile and why do you target that group outside of maybe your immediate sphere of influence? Who are you trying to target and why?
Yeah, so in my case, I'm targeting people like a senior professional, maybe age 45 to 60 range. They've saved enough. Most of those people, at least the people that I used to work with, engineering, project management, they've probably got close to $1 million in their 401k. Typically, they're going to meet the accredited investor at that senior professional level. They're the type of person see layoffs, thinking about retirement down the road, and wondering if they're going to have enough to really build long-term wealth and potentially leave a legacy. They know something about real estate. So ideally, they're interested and they understand the power of real estate. And so they're looking to diversify so they're not beholden to their 401k in the event of a market correction at the wrong time in their career. So
Mm-hmm.
that's who I target.
Awesome, man. You're running the interview for me, Tom, for someone who said, oh, are you sure? Because my next question was going to be, what are their primary motivations, right? Like, why are they investing? You took a very important approach to your avatar, which I'm sure you learned a little bit from Tim and others. But for anyone who's newer to capital raising, right, that's listening, either now or on the recorded version, who you're raising money from is important, but why are they interested, right? You gave two or three reasons why these people, maybe they already know about real estate, the 401k, right? The fear that they might have. That's already in mind for you, which is really important for someone who is quote unquote new to the business. You're taking the two-pronged approach. Who are they? Why are they a potential investor, right? Because you could say, I'm raising money from them because they fit who I am, right? But there's no reason, there's no intention behind it. You're taking the questions right out of my mouth. I love it. But when it goes to your avatar, how do you, is it LinkedIn? Like what tools do you use to find these people the easiest? Because that's a struggle for a lot of people, like finding
Yeah,
where they,
I use a premium LinkedIn account with Sales Navigator, right? So it gives you the capability to basically zero in on professionals who've been with their company for 10 years, engineers, project managers, now also market to doctors a little bit. So they're really high earners, W-2 earners, a lot of them that I've got some connections in that space too. And then you can actually put in a filter in that search in Sales Navigator for real estate, that they have something in their profile or whatever about real estate. So sometimes that's helpful. That can actively send me leads on a regular basis. And I'm really just scratching the surface of taking that information and really reaching out and making connections with those folks.
Sales
That's the plan.
Navigator
Yeah.
is fantastic. It's awesome.
Uh-huh. I'll have to get
If
with
you
you.
got,
That's the plan going forward, is
yeah.
to just really start 10 DMs a day to maybe reach out to a new group every day. That's the goal
Mhm.
going forward.
Yeah, and you mentioned Sales Navigator. Obviously, we drive it home a lot. I think it's the best software everyone should have because it can get so granular. It's not that expensive. I think it's 100 a month,
Yeah.
something like
Yeah.
that in that realm. All these services you would go pay, bring me a list of 1,000 real estate. LinkedIn makes it easy. Everyone gives us all their information, what they do, where they went to school. If I want to reach out, I'll reach out to UCF alumni. It's where I went to school. I can find those people with a few clicks. Free plug for Sales Navigator. Definitely, if you guys don't have it, definitely check it out. And so that's how you find them, obviously. Do that. Engineers are a good one. We recommend engineers to a lot of people. They typically are the guys who maybe they're in crypto and stocks and you can diversify for them. Do your database, your avatar, do they prefer focus on single asset type or diversified among many different? Are they just, hey, I only want multifamily? or do you have many things for me? Do they have
For me, because my background is really multifamily, that's where I've decided to really focus. Yeah, in my case, my avatar is more interested in multifamily because that's really what I'm offering right now. But as
Mhm.
I continue to build out, my goal is to transition into other asset classes as well. I think the multifamily has been a good place for me to start for fund to funds because of my knowledge of the space and being able to complete the due diligence, but I'm interested in oil and gas. I am interested in self-storage. I don't, Scott Kidd is on the call. He's done some raising for self-storage. So anyway, I definitely like the self-storage deals. I've actually been talking to a group who does value add on marinas. I don't, some of you may be familiar with that. They actually own three marinas at a lake very close, about an hour from me here in East Tennessee. I went up and visited one of the marinas and met with those folks, kind of starting
Mhm.
to do a little bit of due diligence there. They've been showing some, they've had some deals with 35% IRR. So, it's a
Wow.
real mom and pop. I think something like, at least not on the coast, but in the interior marinas, like 90% of them, 95% of them are all mom and pop owned. So there's a real opportunity there. But so for me right now, I think my avatar is primarily interested in multifamily, but I'm looking to present more options to them going forward.
Gotcha. Hey man, Scott's got the boat, so the marina of his alley. Very cool. Okay, and that's something I'm always curious to hear, like what different people's investors are looking at because of the last couple of years. I think right now, ironically, where we are personally finding some pretty good deals in multifamily. I think it's looking up towards the
Yeah.
end of this year for sure, compared to where I think a big sentiment right now is I'm out on multifamily for good reasons because a lot of big syndications, the 21, 22, 23 deals, some of them are having issues now. But if you did your due diligence and you did everything the right way, which not everyone does, then most of those deals are secure. And speaking of fund of funds, give us a couple of, for those who aren't super familiar, right? So this is what we focus on too. What are some things about fund of funds that you prefer over the co-GP model and what you were doing before? Give me a quick rundown of, hey, here's why I prefer it.
Yeah. So I had a local deal that I put together as just a 34 unit near my house. And this was back in 2021. It was a direct to seller deal that I negotiated, but I didn't know how to raise capital. I was an acquisition guy, right? So I brought in other GPs and they're all very involved on the GP. So they didn't just come in and capital raise. But that's, I think, the old model of building a GP team to be able to raise the capital is not something that the SEC really likes. They frown on that, right? Everybody on the GP team needs to have a job and needs to be involved in the management of the asset. The fund of funds model is more compliant. And the other thing about it is, as far as from a solopreneur aspect, it's difficult to do everything. So fund to funds, you're focusing on fundraising. You're leaving the finding the deal, structuring the debt, closing the deal, running the deal, asset management, all that. You can leave that to a group. That's what they do. And you can partner with groups that do that. I like doing that locally on, like I said, on maybe some smaller properties, but allowing me to just completely focus right now on fundraising, it's very powerful.
Yeah, and sorry if you guys heard a loud yelp. That was my dog. It's thundering very loudly. She's not a fan here. But you did bring up a couple of really good points, right? And I see this a lot from newer people where they want to co-GP just for experience, which is fine. However, the co-GP model does operate in a sort of gray area in a lot of cases, where especially when you're new, you don't understand exactly what your duty you have to fulfill per the SEC really means. Some people aren't truly fulfilling their duty, and most times it's not the end of the world. But if anything ever happens in that deal, SEC ever
Right.
comes sniffing around, you're in a
Yeah.
lot of trouble.
Right.
And you never ever want to get in trouble with the SEC. It's a big
Mhm.
no-no. That's one of the reasons we like fund of funds is for everything you mentioned, right? And I say this, people say, "Oh, I want to have control over the deal." Do you do your own property management? No, you hire someone for that most often. So now you're just delegating out more tasks to another team. It's just like property management, which is super important. So if you're going to pay someone to do property management, why don't you just have them do the debt and the asset, like everything, and you just raise the money, right? Is the kind of the lens I try to, for those who say, oh, I want to be a part of the deal. Okay. But you're not property managing, right? You're delegating out something. We're just delegating out more, if that makes sense. Yeah, very cool. So yeah, I think we're basically on the same page there. And so now you're doing fund to funds, right? Obviously, the investor acquisition process is, for most people, the biggest hurdle. So when it comes to once we've gone over like how you find them, how are you maintaining long-term relationships with your investors? Are you using newsletters, direct mail, just kind of mail, like once you have got them on the phone and you've built the relationship, how do you make sure that they stay top of mind for 6 months or a year between deals?
Yes. Ideally, I send a newsletter, not a hard copy through mail, but email, newsletter, ongoing email campaigns just to let them know what I'm doing, try to stay connected on social media. And as I mentioned, my investor base at this point is still pretty small. I took one of my investors to a AA baseball game the other day. And I sent a book to another one who was curious about, wanted to learn a little bit more about syndication. So I just got on Amazon and sent her a book. Yeah, like I said, that's very personalized because I've got a small group right now. And the challenge gets more as you expand that. But I think it's just the constant touch points and just staying top of mind. And that's certainly what I will try to do.
Yeah, I love the personal approach instead of just automate everything, which we try to do. You want to automate as much as possible, but these are people, right? They're giving you money, they're not paychecks. So that's really cool that you, hey, you're interested in this topic. I'm going to go buy a book and send it to you before you've given me money, or maybe you have or haven't. So I really like that. It's a very good touch. And so for these people that, you're taking them to baseball games, you're going to dinner, how do you ensure that funds are available when a deal comes up rather than constantly needing to hustle and scramble? Are you every 30 days probing them? Hey, I'm looking at this deal right now. This is on the horizon. How do you approach that right now?
Right now, for me, it's a hustle. I'll be perfectly honest. But that's the goal is to get to the point
Mhm.
where you've got investors that are interested and know. And I've already planted the seed about the marina fund with some of my investors, and actually they're interested in that type of a thing. Yeah, I think it's just continuing, yeah, especially when they tell you I'm interested, but right now I don't have the funds. So they say no. That's when you ask for a referral immediately because if they know you and they just told you no, they want to give you something. That's probably the second best time to ask. The other time is when they actually wire their money, is to ask for a referral. For me, it's just constantly the outreach and trying to stay top of mind, like we were talking about. But at this point, that's still a work in progress for me.
Gotcha. It sounds like you're doing some of that. Not
Yeah.
necessarily having the funds available $1 million right now. That's tougher to do for a lot of people, even if they're a very successful capital raiser. But planting that seed, hey, I'm looking at this marina thing. In a month, you send them some more info, you send them the property info, and probing them. So when that deal does come up, they're not blindsided. Oh, what's this marina deal? You never told me about this. Isn't,
Sure.
especially if it's not multifamily, your normal
Yeah.
asset type. So you're still doing some of that, which is still really good.
Yeah. You don't want to look like an opportunist. You want to look
Yeah,
like it's fairly carefully thought out. You just need to make sure they understand that.
gotcha. Yeah, that's exactly right. And so when it comes to the fund that you've, how many funds have you done so far? Is it the,
This is my first. I am on
yeah.
my first fund of funds right now.
And are you doing an SPV fund as well?
Yes.
Okay.
Yes. It's a special purpose vehicle for one specific deal, fund of funds for one deal.
Yeah, which is our preferred method too. It's cheap, which everyone always loves, and it's very simple. It doesn't confuse
Yeah.
the investor.
Sure.
I'm assuming, and maybe I'm wrong, that you looked at other types of funds, and I'm always curious to ask, what made you decide on SPV versus maybe like a customizable or a series fund where you have one PPM and you put many deals in there? Or did you not really consider those?
I did. And what I heard, and especially getting into the space, as we've talked about, it's all about a story. Your investor, obviously, they have to trust, they have to know and trust you, but they're also going to buy into the story of a property, right? Maybe when your track record is huge and you've raised successfully for a bunch of deals, then you've got a group of investors that are willing to provide money to a fund where they don't know exactly what you're going to put it into because they trust you to that point. I think from my standpoint, for starting out and to be able to tell the story of a specific deal I'm raising for is a very interesting story. And I've enjoyed telling it. The building was an apartment that was owned by a mission group, and they had a change of who was running the group. They had a drop in folks that were living there and employed by the mission group. It got down to 60% occupied. And this was a direct to seller deal with no brokers. Those are the types of deals, details that make it interesting and specific. So that was the route I chose to go because you're raising for a specific deal rather than a concept of what you are interested in.
Yeah, and I think it's really important having something the investor can see and it's concrete when you're
Yeah.
doing a fund of funds. It's not an idea of, hey, I'm raising money for multifamily in Texas. It's more concrete, especially when you're new. Hey, you can touch and feel this. If it's local, they can go see it if they really want to, especially if they're a big check writer, maybe they might want to. And those are a lot of the reasons that we prefer SPVs too. So I'm always curious to hear people's different takes on that. I wanted to ask more about this as well. The 2008 market crash, you had mentioned you were somewhat involved. Did you have any experience with properties that went south during the market crash? What was your experience like with that? If so, did you own any single family homes back then?
Only my own. And I actually had borrowed against it to go into that retail venture that I spoke about. I lost more than 100 grand, which 15 years ago was a little bit of money. Luckily, it wasn't a huge chunk, a debilitating. I basically borrowed against my home, and then my home value reduced to the point where I was probably underwater for a while. I'm still living in the same house. It's a 105-year-old farmhouse that I live in. That was how it affected I was not a real estate investor at that particular point in time, but the retail venture took a big hit in that market correction, that's for sure.
Yeah, and it might seem out of left field. The reason I ask is because I'm curious. 2008 happens. Multifamily is almost too big to fail since 2012 till really
Yeah.
about COVID or thereafter before the rate hikes. And then most of us know what happened then, right? And
Yeah.
so comparing the last 20 years, you've been, whether it's a homeowner interested in the retail space now since 2016, an active investor. What do you think some of your predictions for the market are? You're actively looking at deals using that 2008 as a backdrop. I don't think it'll get that bad. Things are looking up. How are you preparing to thrive in the upcoming market, and where do you see things going in the next couple of years?
I love it. I love the market. Basically, we've got a situation. I think everybody knows there's not a lot of starts going on now. So we've got an absorption issue right now for all the building, specifically in the Southeast and the Sun Belt. One of the reasons I'm focused on the Midwest is because they didn't really build like what was going on in the Sun Belt. There's even less deliveries coming online now and fewer starts in the Midwest than there are in a lot of other parts of the country. Kansas City led the country in rent growth for the 1 year period ending March 30. It's cooled a little bit over the last couple of months. It's got rent growth of around maybe 2 to 3% or under 3, but 5% rent growth over the last year. And that Kansas City area, it's huge and continues to grow. And there's going to be, I think, as it continues to grow and without a lot of deliveries coming online, I think the conditions are great. There's a lot of uncertainty about a variety of things in the economy that leads to uncertainty. and that can be a good thing. Certainly, there's a lot less competition right now than there was a couple of years ago. Going to conferences, big conferences with a lot of syndicators, the attendance is probably a third of what they were a few 3 or 4 years ago. So, I think as long as you've got solid debt and you're in a strong market that continues to grow, I think the prospects are awesome. I'm very excited about it.
Yeah, I'm glad you say that. As a Tampa resident, I can tell you the building here has been insane. The overdevelopment of Florida as a market is pretty well known at this point, but I see a new apartment complex the last few years, I feel like every week, right? And so it's interesting you mentioned the Midwest, which typically people aren't as bullish on, like we've seen the last year or two. When more people are on the sidelines, there's more opportunity, right? Whether that's good or bad depends on the kind of deals you get. But like you said, Kansas City, there's probably not a million syndicators looking to buy in Kansas City, right? A lot of them probably think it's in Kansas. Since people don't even know what some of these markets are, you create an advantage, right? Which is something that I don't think enough people do. So it's really, I love to hear that insight where, hey, we focus on Tampa or Texas because that's the markets we know, but not everyone should always just focus on the biggest markets, right? Look
Yeah.
elsewhere, even if it's not sexy, so to say. And I
And
do
this
agree with
group,
you that the market is looking up. Go
and this group that I'm aligned with, they're based in Kansas City and they've got 8 properties in the region, 2 properties very nearby this other property. So there's economies of scale, management,
ahead.
renovation, efficiencies, and that's what makes the deal so compelling.
Yeah, and we are seeing in general the suburbs, right, around big cities, Miami, Tampa, Orlando. You're seeing a lot of people because it's so unaffordable moving to places like Ohio, Missouri, Kansas because for 300 grand, you can get a nice house. Whereas in a big city, that's a tough ask right now. Or you can rent a very nice apartment for $1,500, which can't do here. I'll tell you that much. So you're seeing a lot of people flock to the Midwest because it's way more affordable, which brings industry, business. We've seen it a few times. Really interesting insight. Love to hear it.
Kansas City is also
Um,
very diversified. KC is a super diversified market, so there's no one employment sector. I think the health services is like 15%, and that's the highest of any employer sector. So that's another pretty compelling thing for the markets. My son is trying to sell a house in Tampa right now, Logan, too. And he looks like he's going to have to possibly lower the price.
it's tough here right now. A couple of years ago, 2, 3 years ago, you have people throwing money at you, but
Yeah.
they've overdeveloped like crazy in Florida specifically because after COVID, we saw a huge import of people, which was good for the short term. Long term, it's looking a little grim, which other people in other cities I'm sure have also seen right after COVID. It's definitely not me that's alone in that prospect. So good luck to him, though. I hope he gets it sold for asking for sure. And we kind of talked about the market, your journey through raising money. And for a lot of people, you're only as good as some of the tools you use, right? You can do a lot of the stuff on your own, the stuff that Tim teaches and other people, mentorships and stuff that they build your CRM and they do this and that. You can do all of it on your own. It's just way more time consuming, a lot more stress. So, what are some of your favorite tools, resources, softwares, syndication software, investor portal, stuff like that you rely on that you recommend to other people?
I guess the thing that comes to mind first is ChatGPT, whether it's any of whatever you're doing, it can be utilized for everything. And I use it all every day, all the time. But obviously, ChatGPT, Syndication Pro is what I use for investor portal. I'm actually transitioning from active campaign to go high level. So that's something I'm doing right now. I use Real Estate Lab for underwriting deals, is a online excellent underwriting tool. We use Appfolio at the PM level for our properties mostly. One of the things I heard the other day was somebody talking about taking data from Appfolio and put it through Zapier to ChatGPT for data analysis and reporting, which is something I think I want to try. That sounded like you can connect your property management software to ChatGPT via Zapier. So that sounds like it's got potential. Is that what you were talking about? That those types of tools?
Like any type of software or websites that you use, chat think not enough people use because they don't know the potential. So I love to hear that. But any other, we went over LinkedIn Sales Navigator, but any other companies or tools you use on a regular basis for investor portal you went over? Yeah.
That just the ChatGPT landscape is changing so quickly. The ramifications are mind-boggling.
Yeah. AI over the last 3 years has, if you haven't been using AI in the last couple of years, you might think that it's just normal. It can do stuff that it could not do 18, 24 months ago. It is insane. So I recommend everyone go look up. We use Claude for a lot of our AI script writing, content creation and stuff. ChatGPT is another really good one. And there's a ton out there. So definitely check them out for those that are listening. Very cool. So we get all the tools, we know your journey and everything. If you could go back and restart in 2016, what would you do differently? Your whole journey? Or would you do anything different?
I guess the one thing I did was buy that 13 unit, which was probably the smartest decision I ever made. I didn't get caught in analysis paralysis, so it was just a matter of taking action because I bought that for 450,000 and sold it for 1.3 million 7 years later. Not because I was a genius, but because the market here in East Tennessee supported that. And I did a pretty
Mhm.
good job with the value add business plan. I would focus on capital raising more than just acquisition. I would have started that sooner. I wouldn't have had to bring in GP partners for the 34 unit that I purchased, or not as big a group, and wouldn't have had to give away as much of the deal. I think I probably would have continued looking at smaller properties through this downturn. I got focused on bigger is better. Oh, let's just keep doubling up the size of your next property. And I think that was difficult over the last few years to really make deals pencil, whereas smaller properties, you can always potentially find somebody who owns a property, direct to seller financing, gives you a little more creative options. So I think I jumped to looking at bigger deals at a time where the market didn't really support it very well. Network is your net worth. I'd heard it for years, but I think it's finally starting to get through my thick skull that you've just got to constantly be making connections, networking, and calls like this such a great way to do that. Augment the long-term syndications with more cash flowing investments like debt funds, income funds that actually kick off cash flow. Because as a syndicator, I think anybody on here that's a syndicator knows it's not a real cash rich business unless you're doing a lot of deals and maybe you got an acquisition fee, but through the life of a 5 year hold, you're not really pulling much cash out of that deal until you sell. So in order to be a real healthy syndicator and sustain a lavish lifestyle like we all want, it's not a
Mhm.
bad idea to also have some investments that are really cash flowing steadily. I'm focused on that now. Maybe would have started doing that a little bit sooner.
Capital raising, right? We talked about it. You don't
Yeah.
want to, sure, it's nice to bring in a group and raise $5 million or whatever the case is, but you're giving up a lot of your deal. And that's it's a bad habit to get into. What if you can't find a group that likes your market, likes you, likes your deal? Is that 3 or 4 months you just spent gone? That deal not going to close? We see it a lot. You've experienced this with a previous deal, right? Where it didn't close. Stuff happens. And also, if you can raise money, you can do a lot of stuff. You can pick and choose who you want to work with because if you say, "Hey, I've raised $5 billion," people want to work with you. It opens a lot of doors. And then also, obviously, cash flow, which we would all love to have, but for newer people, for most syndicators, it's not always the most lavish income per month you're making based on whatever your splits are until you sell, which is the ultimate goal. Some people are okay with that, but you hit all of the big topics, right? This is the capital party. And you said, hey, I would have raised money if I could start over, which I always love to hear. And that's our bread and butter is raising money. Awesome. And you've been super generous with us, Tom, sharing your knowledge with us today. What's the best way the audience to get in touch with you and connect with you?
Really connect on LinkedIn. I've got a current raise. Any aspiring fund managers, we've got with Oak IQ, who I'm raising for in Kansas City, they've actually started building out a little infrastructure for fund managers like Tim is doing also. It's just a matter of continuing to network. So for me, I think connecting on LinkedIn, engaging with my posts, and carry on the discussion further would be great.
Awesome. I put your LinkedIn down there in the chat. And then aside from your deal, is there anything interesting or fun happening in life outside of your son hopefully selling his house? Anything else less business related that's going on, or anything you want to share?
Heading to Ireland for about 9 days in about a week and a half. So
Ooh.
that's pretty exciting. I've got a new grandson who's about 9.5, 10 months old. So that's pretty exciting too. And we have a new dog that's in the house that loves my wife and kind of growls at me.
Oh man, that's awesome. Hey, if you can't tell by my complexion, you're going to my homeland. My mom is from Ireland. She was born there.
Okay,
So,
nice, nice.
in
Yes,
Ireland,
sir.
England, and then moved over here. So have fun. That's going to be awesome.
I'm looking
But
forward.
I really appreciate you taking the time out, coming on today, and letting me interview. Let me do my best Tim My impression. I hope I did a good job, everybody. Sometimes I talk a little too much, but that's okay. It is an interview after all. But post anything else in the chat that you would like. And what we can do now is open up for Q&A. I saw a few questions in the chat as we were going. So anyone who had any questions for Tom, I'm going to run through some that I saw, but any questions you guys have, raise your digital hand and we will have you guys come on and ask Tom any questions that you have. While we're waiting for that, I'll go through and see a few questions that I think people asked. I saw someone ask something about your deal.
I just put my Blink card in the chat also. If anybody
Okay.
wants to connect with me that way, that's got all my information in there.
Awesome. Yeah, Tate asked, what's your current deal look like? I think you touched on that a little bit already, but if you want to go deeper into that, you can.
The current deal, yeah, it was called Hernhut Apartments. It's 131 units and it was 60% occupied at purchase, direct to seller. There was no broker involvement. Really good, purchased at a very good basis. The business plan was to renovate all the units with a budget of about $12,500. So far, as it turned out, the deal closed in December. Part of what makes it an interesting story is that we had a 1031 buyer who was bringing $1 million to the deal. They had a building burn, and so they borrowed $1 million to close the deal. They wanted to close it in 2024. So they borrowed $1 million, which we're just backfilling now. There was a short-term loan that's what we're raising for right now. But the good news is because it was, employer owned, you had all these people living in there. They all took great care of the apartments. So what we're finding, especially with kind of maybe softening of rent growth a little bit right now from the 5% growth over the past year, it's not really paying to do the renovations. We are actually doing like a regular conventional turn and we're getting our pro forma rent already. So we've already leased 16 units in June and even more in July that are coming in at pro forma rents without doing the full renovation budget. So that's really awesome. Amazing thing. Therefore, some of the renovation dollars were going to be coming out of the loan. It's actually a local community bank loan that was helping fund the renovation. So
Mm.
instead of having to draw on that to do further renovations, they won't necessarily have to do that. And so I think it's for an already very strong deal, it's even stronger. So the other interesting thing about this deal, because it's already closed, my fund was created June 1. Even for anybody who comes into the deal in August, their pref will accrue from June 1 when I created my fund, rather than if somebody sent money on August 15th, they're already going to have 2.5 months of 7% pref. So it's in the Overland Park area of Kansas. I actually went out there for 3 days, met with the operator team as part of my due diligence, toured a bunch of their properties, and I feel real good about it.
Awesome. Very cool. And it's always good to hear that they're kept in good shape. Tell you what, man, that's something you always are glad to hear. If anyone's interested in learning some more, it's a very interesting pref structure. So you get the benefit of coming in late still. So if you guys are interested, definitely reach out.